There tends to be a very simple and similar progression of thought in, I think, a lot of aspiring traders who finally understand the potentials the prop firm space has to offer, meaning you're getting access to someone else's money so you don't have to use your own. Wow, they're going to give me $100,000? I don't have $100,000 that I could deposit in my account. That's awesome. My buying power is going to be super big. I'm going to be able to trade like huge size compared to what I'm used to. This is going to be amazing. To then, man, you know, a 100K account, yeah, but it's not as much as I thought based on some of these rules. Like, it's kind of annoying. Like, I can't really size as big as I maybe once thought I could. I wonder what it would be like if I didn't have these drawdown rules. To then finally, screw this prop firm shit. I'm done with it. I got to trade my own account. How much money do I need? Raise your hand. I know we've been there, at least at some point, or we thought about it to some degree. So let's figure this out. How much money would we actually need if we wanted to trade our own money and not have to deal with any of the downsides and the rules that come with trading a prop firm account? What I want to do is I want to start with an example from the video we talked about how much or how long it would take you to break even on a prop firm account. If you haven't seen that video, it's a great video to go back and check out. But in that video, we were talking about a $100,000 account, and we assumed a couple of things. $100,000 account, 8% static drawdown, 3% daily drawdown. Our max risk per trade was $800 in that video because we assumed a worst case scenario of losing 10 in a row, which is probably not super likely at all, but worst case scenario of losing 10 in a row. And we risked $800 per trade. And we were looking at that as like kind of like our baseline. And we came out to an average trade expectancy of $200. Now, I'll talk about how we got there in a second, but those were kind of our parameters. So based off those parameters, once funded, we'd be able to make about $3,000 per month on average. Again, these are all averages because like obviously we're not going to make $3,000 a month. We're going to make maybe 1,000 here and then 6,000 and then we're going to lose 1,000. Like it's going to be all up over the place, but it will average out to be about $3,000 a month if we take 15 trades per month with a $200 average trade expectancy. Our goal now in this video is to structure or figure out an account size to where we could trade with the same sizing, meaning our average expectancy would be about $200, and not have to deal with the rules and the prop firm stuff. We could just deal with our own account. Now, I know your question, your thoughts are going to be like, well, just dude, utilize leverage and margin or whatever. And before we talk about those things, like, I don't think that they're as important as maybe people think they are, because a lot of us will realize this too. Like, the longer you're in the game, like, it's not about trying to make as much money right now. It's about like the longevity of it. Like, can we build a system where we can like actually rely upon it? And when you start utilizing super big leverage, like, yeah, you can start with a lot less money, but if you lose like 3 in a row, like you can blow yourself out like massively. So like, is that worth it to you? I don't know. If it is, then maybe this is not a video for you. Okay, back to the goal. Average trade expectancy of $200. We have a 50% win rate, a 1.5 reward to risk ratio, meaning we make 1.5 on our winners and losers. If our max loss or our loss or risk level is $800 per trade, that would mean $1,200 in winners on average. So we risk $800 to make $1,200. Noting our worst losing streak could be 10 trades in a row, we now have to figure out how much money we need. Making it super simple, in theory, a $10,000 account, if you lost 10 in a row, risking $800, would draw you down to about $2,000 before you win again. In theory, that's like, okay, well, that's the number. Just have about $10,000. Technically, you could do it with like 8 or 9K if you really want to walk the tightrope, but it's not that simple. For example, if I had $10,000 in a brokerage account, utilizing margin intraday, I might be able to get about 3x that buying power, depending upon the brokerage account. So I'd be able to get about $30,000 in buying power. Now, $30,000 in buying power off the top of my head, multiplied by a 1% move in, let's say, an underlying stock, would get me $300. So $300 is like, it's not going to work because I'm looking to risk $800 to make $1,200. So I need bigger moves than that. So for like intraday trading on a stock account in the US, like probably not, like that's probably not enough money. So you would probably have to look towards swing trading there. And if you were to swing trade, you would maybe look for, let's say, a 5% risk on a downside of a move to make 7.5. So like you're risking, let's say you're going long or short. Your risk is 5% on this move, and I'm looking to make 7.5%, like on average. And if you were to back into those numbers, in order for you to get that 5% to be $800 risk, you would need $16,000 of buying power. Okay, cool. $16,000 of buying power equates to about $8,000 of your own cash if you're swing trading holding overnight, because they'll give you about double in buying power overnight. So you need about $8,000 in cash. The problem is that as you draw that down, $8,000 down to 5 or down to, let's say, 7, 6, 5, if you go into a losing streak, now you don't have that same buying power, so you need more. So $8,000 is like the minimum for a swing trade approach stock account in the US, at least 10K. I would say at least 10K. And at least 10K is to meet the same numbers that we were getting with the $100,000 prop firm based on our average trade size there. Now, if trading futures, different ballgame, very different ballgame over here. So for the sake of this video, I wanted to use the margin requirements from Ironbeam, who is also the sponsor of today's video.
Welcome to Ironbeam, the future of futures trading. With our cutting-edge chart trading feature and 300+ indicators, you can now trade directly off the chart anytime, anywhere. Delivering seamless trading across all platforms, the Ironbeam journey is supported by 24-hour trader support, low day trade margins, and no account minimums. Ironbeam brings the future into the present. Join now and augment your trading experience.
Now, day margin on micro futures contracts for the Russell, S&P, and the Dow, I believe, are $50. It's $80 for the NASDAQ, more expensive. You need to take on, they need to have a little more cushion in your account. That's if you were to day trade. So you can't draw below $50 or I guess $80 in the NASDAQ. But let's just call it around between $50 and $80. You can't draw below those numbers intraday. If you do, they liquidate your account and you're out. So you have to hold at least that much money in your account. So technically speaking, if you only day trade, you do not need a lot of money here. You just need enough money to where you can handle the $8,000 drawdown and still have north of $50 in your account or $80 to the NASDAQ. So in theory, you could go with around 8 to 10K. I would say cushion 10K starting, but you could in theory go with around 8 to 10K based off of that logic. Now, if you want to swing trade and hold into the close of the future session, so I think it's like 5 p.m. Eastern time, whatever time it is for you, Central, whatever time, wherever you live, futures close about an hour or so after the stock market closes. Like, they're still obviously after hours trading, but futures close and the next day begins an hour later. So like the overnight is like an hour long, which really is not that bad. But if you wanted to do that, there are higher margin requirements. So for example, with Ironbeam, your overnight margin requirement for holding the micro E-mini Russell would be $792, meaning you can't drop below that amount and have one contract of the Russell in your account. They'll liquidate you automatically. So if you're playing bigger time frames and you would hold, let's say, through a day or two, or even like, you know, sometimes you'll have a 10-hour trade, like you have a 4-hour time frame or a 1-hour chart, and it will just happen to go through those periods. That's totally fine, but you just have to have more money in your account. So you would need to have $792 for the micro Russell times probably about 2 contracts if you're swing trading to have anywhere in the ballpark of like what would make sense for the risk reward profile to also line up with the $100,000 account we were talking about on the prop firm. So your initial margin requirement or your overnight margin will be about $1,584. Let's call it about $1,600. So you can't drop below that. You would then on the micro E-mini NASDAQ, $2,057 is your overnight margin for one contract, times it by 2. About $4,114 is going to be what you can't drop below if you're trading 2 contracts of the NASDAQ in swing trading. So based off these numbers, 10K is probably like the minimum you'd want to have if you're trading the micro Russell, and about 13K enough to swing trade the micro NASDAQ and be fine and be in that ballpark. Again, it's going to be a little bit, it's not perfect because everyone's sizing and their targets and stuff is not going to be the same, but this is like the minimum that I would say makes sense. So long story short, based off of what we just talked about, like you could probably get away with $8,000, but you probably need to have north of $10,000. 10 to 15K is like a good like starting point. But with that said, you will have to be able to deal with drawdown. So if you do lose a couple trades in a row, say you lose 5 trades in a row, you're drawing down $4,000 of your own money. Are you okay with that? Whereas a prop firm, if you lose 5 trades in a row with the same sizing, you would draw down of $4,000 of someone else's money. All you put up was, let's say, $500 to buy the challenge account or buy the account that then now you have gotten access to the funded stage. Hence why the props are so intriguing. So what is my honest take about all this stuff? I personally think that if you have more than $15,000 to take and put it in a brokerage account and not care, like if you had that 15K and you were like, it's not going to hurt me at all, paying the bills, stress me out, this, that, I'm going to put it over here and I can trade, like, fine, totally fine. And it would also not be a bad idea if you had the 15K and had a decent enough income to where, like, if you had to replenish it, you could always replenish it every couple of months with some money if you're losing, to like maintain, or to like, you know, if you're losing and that learning curve is taking some time. Sure, realistically, you could just trade, you know, a paper account or with a smaller prop firm account to get real money experience, build up your data and stats before you go to your own money. But that's like my take. So really, once you get north of $15,000, now you're able to size up a bit more on your trades. And now you start playing with, in my opinion, money that makes more sense to just trade your own versus the prop firm and have to deal with the percentage drawdown rules, etc. However, vote for the prop firm side would be if you have a static drawdown account and you are able to not take out the full amount that you make every so often. So for example, if you make $3,000 a month on average, 6 months down the road, you're up, you know, a good chunk of change. But let's say you only took out $10,000. You would be now at $108,000 in your prop firm account, and your static drawdown is at $92K still. It stays there. So now it offers you the ability to scale up your trading just a little bit, but you're also bound by your 3% daily drawdown in this example. So you just got to be careful of that. Eventually, you'll catch up to that 3% daily drawdown, so you can't lose more than, let's say, $3,000 in a given day. But again, if we were risking $800 per trade and we take like one trade per day, even if we take 2 trades per day, okay, like we can size it up. So maybe you can start risking $1,000 or $1,200 on your account to make 1.5 that. So let's say you're risking $1,000 to make $1,500. You know, it starts to increase your average trade expectancy, and you can make more money in a given month with that type of sizing. Hence why when we bring it all back, I do say that 15,000 is the number. Yes, it could be done below that with your own funds, but I think 15,000 is where it becomes like, okay, the pros outweigh the cons of this, and I think it's worthwhile to roll with your own money. Let me know what your thoughts are in the comment section down below, and if you are looking for a video that dives into how long it will take to break even on your next prop firm challenge, the video up on the screen is for you. Peace.